Welcome, everyone. I think we're live. Thank you for joining us. My name's Steve Skura. I'm the Director of Marketing here at The Lonely Entrepreneur. Joined by the amazing Sam Langford, our Executive Director of Entrepreneur Success, the wonderful
Hey.
Victoria Sherman, our Global Head of Operations, and our fearless leader, Michael Dermer, CEO. And Michael founded The Lonely Entrepreneur to basically create a one-stop shop for entrepreneurs. And we now have a growing community of 4,000 entrepreneurs. He's coached and consulted more than 600 CEOs. And today we have a really important topic we're covering on how to build trust. So building trust, the key to business success. And this presentation is going to be about 30 minutes. We'll have 15 to 20 minutes of Q&A live where you can ask Michael any questions around building trust or anything else that's top of mind for your business. We have about 40 people that have signed up for this webinar today. And stay till the end. We have a bonus offer we want to share with you. And now I want to turn things over to Michael. I hope you enjoy.
Thank you, Steve. And thanks, everybody, for taking time out of your day to join us. I'm going to kind of spin up a presentation here that hopefully you guys can all, can everybody see that? Terrific. No?
Take a minute.
There we go. Yep.
There we go.
Okay. Thank you, everybody. As Steve mentioned, the topic of today's conversation is about building trust with, these critical resources, staff, vendors, and investors. And, when you're an early stage company, finding resources that you can have faith in is super, super important. So we'll give you a little bit of background on Lonely Entrepreneur and then get right into our topic. As Steve mentioned, the Lonely Entrepreneur is really designed to help you at every step of your journey. We have two solutions that are designed to do that. One is what we call the learning community, which is the first one-stop shop for entrepreneurs. So learning modules, coaching, a place to get your questions answered if you're in your early stages, kind of the perfect resource to have one place to go that you can get all the answers you need. And then for those of you that are further along, we have our one-on-one sidekick consulting practice. This is a one-on-one consulting practice that is designed for, companies with, $1 million to $25 million of revenue. As Steve mentioned, we've coached and helped over 600 CEOs of different companies. So as Steve mentioned, we'll have an offer for you at the end of the webinar. So please hang around. So more importantly, the topic of the day is, how do you build trust in a fast-moving community when, in the early stages of your business and the growth stages of your business, you really want to find those that you can really rely upon. And the real challenge, in this day and age is, how do you build trust when we experience the things that a lot of us experience along the way, that staff often fails to meet expectations. We have a chapter in the book we call Everybody Sucks, right? Because in the beginning, and even at growth stages, it seems like, the resources that you have, regardless of where they are, and regardless of what they're doing, always seem to fall short of your expectations. So it's so hard to build trust in people when you experience that a lot. That's not to say that, all of your people struggle, but it's just one of those things that we all experience along the way. Next is, how do you build trust when you have multiple staffing models, right? You've got employees and 1099s and full-time and part-time. And now post-COVID, we've got work at home. And then the whole, kind of offshore, if you will, ecosystem of people where, you're regularly integrating in people from all over the world into your delivery model, right? Which creates an incredible amount of inconsistency. So how do you build trust when that happens? Next you have lots of experiences. If you ask 10, $5 million companies, one thing that almost all of them would have experienced is that a challenge with a marketing firm. That many marketing firms that they've worked with have, kind of overpromised and under-delivered. There's lots of good marketing firms out there, but almost everybody has had experience where it's hard to, quote unquote, trust your marketing firm, which is so critical when you're growing your business. And marketing firms are just, one type of vendor. right? There's many, many other types of vendors that it's really hard to build faith in those vendors. Because a lot of times, again, while there's many good vendors, they fail to meet your expectations, and they fail to be a thing that I know I have always struggled with, which is being proactive. You can always find folks that can do what you ask them to do when you pay them after you ask them, right? But isn't our expectation that we want people to be proactive, to be bringing their expertise? And how do you build trust when people aren't thinking about it the way you're thinking about it and proactively bringing solutions to the table? And then finally, the area of investors and money raisers. And I want to address this issue because I think a lot of times people that have never raised money before, or going in it to the first time, or maybe have raised their first Series A or their first serious angel round, don't understand that in a lot of ways, even though investors are there to give you money for your business, a lot of times the incentives that investors have don't always align with the leaders of companies. And so how do you build trust when those natural incentives aren't normally there? Okay. And what we're going to try to do is to really understand what it means like to build trust. Now, I think probably the perception that most people have is, oh, I'm going to trust people. They're good people. They act well. And that's not trust in a business situation. Okay. That may be trust in a personal situation or relationship situation, but it's not in a business environment. Or put differently, trust is not developed from having a belief or a faith that a resource or a person or a vendor will deliver something. That is the trust that you develop in personal situations, right? Trust in a business situation, I guess, in my humble opinion, is that it is earned. It's not given. It is earned from two things: taking ownership and consistently performing. Right? So why should you trust a resource? It's not because you have a faith and belief. And let's say, for example, somebody introduces you to a marketing firm. Why should you trust them? You're going to trust them because your colleague introduced them. Well, that's a faith and belief that they're going to deliver. No, that trust should be earned. Right? And that trust being earned, how does it come from? Where does it come from, rather? It comes from somebody taking ownership of something. Right? I own a goal. I own an objective. I know what you want. And that means being proactive and consistently performing. And when they do that, you trust them. Okay? And I think just even the mentality of how you approach trust. Hey, I brought an employee in. They come highly recommended. I interviewed them. They're a great human, blah, blah, blah. Do you trust them? Right? Because remember, trust in personal relationships is different, right? Here, what you're talking for is, can I rely upon them to give them things that they're going to take and own and deliver against? That's what you're really looking for is individuals that you really can rely upon to do that, right? And people that build multiple successful companies often get a group of people around them that they trust, so they just bring them in, right, to the next company. And they may not know anything about what the next company does, but they know that they trust them. For any of you that have read the great book, The 5 Dysfunctions of a Team, they talk about 5 dysfunctions of a team that works together. And there's a pyramid. And at the bottom of the pyramid, which is the largest block and the most important block, is lack of trust. And if you have lack of trust in your team, all the other parts of the pyramid can be perfect, right? But you're built on a foundation of trust. Okay? Almost think of it this way. Think about in your own company, if you have a resource that you just know consistently doesn't get it done, and yet they're still there, right? That's really debilitating to an organization, especially at early stages. Okay? So don't think of trust as kind of a visceral, emotional thing. It is earned from ownership and consistent performance. Okay, so we've identified, there's more than this, but we've identified, 3 critical areas that you want to try to say, okay, how do I develop trust in these people? And we're going to cover staff, we're going to cover vendors, and we're going to cover investors and those that help investors. So first is with staff. And again, I want you to think of staff as anybody, right? I want you to think of anybody who you're as an employee or a 1099 or a part-time or whatever it may be. Right? This is what I mean by staff. Okay. How do you develop trust? Well, you're going to put in place mechanisms that are going to enable them to take ownership and perform. Remember, that's the definition of trust. So how do we set it up so we know whether they take ownership and perform? Well, first of all, you have to have clear roles and responsibilities. If that staff member doesn't know what they're supposed to do, what do they own? Right? How do they know? So make that clear. Okay. Secondly is objective goals and performance measures. What are the numbers? Right? Not conceptual. The example I've used before is that if you have a daughter and you want her to do better in school, you can say, I want you to improve your grades. Well, that's good. Or I want you to have a 92 average. Those are very different things. You can manage to a 92 average, right? Because when you get the first test back and you get an 89, you're like, I'm going to hire a tutor. I'm going to spend more time, right? Whereas if you don't really have, so they have to be objective. And don't worry about them being perfect, right? Sometimes people, it's hard to predict. I don't know. It doesn't matter. Just put a number in place and feel really solid about it and manage to that. Okay. Next is a regular and consistent process for measuring to those measures. Okay. So let's say you want to have your daughter get a 92 average. If you're only measuring that once a month, what can you really do to impact, right? So that you can ultimately learn to trust that individual. Well, it's just once a month is not enough. Right. And people say a lot of times, well, I don't want to have more meetings. No, that's not the point. The point is when you let things go, right, you don't have the ability to adjust, and you don't have the ability for these staff members to, quote unquote, step up. What does step up mean? Take ownership and perform, right? The definition of building trust. You build trust by watching people every week take ownership and perform. And sometimes they are taking ownership when they're not performing. I know I own this goal. I know that I'm falling short. Here's what I'm doing about it. Right? And those things build trust. Somebody that goes, well, I know we fell short and it's because somebody else did something, right? Which is the antithesis of ownership, right? So even them taking ownership when they're not performing is part of the way that you walk away and go, listen, obviously getting the result is what's important, but I can tell you, we've all seen this. I'm sure everyone on this webinar has experienced this. We've all seen people fall short of a goal and not really take responsibility for it, right? And that is part of, remember, trust is earned, right? And it's earned by consistently performing to measures. And then finally, when it comes to staff, my advice to you is that you never should have a lack of expectations of folks because somehow they perform for your company in some different staff model, meaning they work from home, they work from overseas, they only work part-time, they're a 1099. If you knew the number of times people said, hey, can you really expect 1099s to perform the same way that you expect employees to perform? And somehow we've accepted that. Right? Can we really expect people that work from home? The problem is that if you start adjusting your performance expectations to each of these different operating models, it's never going to fit perfectly. Okay. So part of the way that you build trust is by putting in place these tools and techniques of clear roles, objective goals, regular ways of measuring, and applying across the board to everybody. Right? And it doesn't matter whether you're in India or Pakistan or Iowa or you're part-time or you're 1099 or you're whatever, you work from home or whatever it may be, right? What you're trying to do is to have people that earn your trust because regardless of the circumstances, they very clearly understand what they're supposed to do, what their goals are, that they're going to be held accountable and take ownership for it each week, regardless of how they're set up. Okay, and these are the things that when people in these regular and consistent processes with clear goals perform and take ownership, that's when you start to trust them. Okay, and these are even things that you can say to your staff, right? You can say to them, this is the expectation that I have of you. And if you can't do these things and I make those expectations clear, it doesn't make you a bad human. You just can't be here. Right? Because I need people around me I can quote unquote trust which means you're going to own and perform. Okay. Next, vendors. Whenever you're working with vendors, and vendors are run the gamut: marketing firms, IT firms, lawyers, the list goes on and on, consultants. It all starts during the process when you interview them and you procure them, right? You want to set the tone, right? And you want to try to understand, right? Are these types of firms? I'll give you an example of a couple of interview questions to use at the end. But let me talk to you about the techniques to use with vendors. First of all, you should be tying compensation and how they get compensated to results, right? Many vendors will say to you, we're all about results. We're all about getting the results, right? Well, if you say that to if a lawyer says that, you say, great. So if you win the lawsuit, you get paid more. And if you lose the lawsuit, you get paid less. That's what you mean, right? That's results. And they'll say, that's not what I really meant, right? Or you interview a marketing firm and they say, we're all about results. We'll go, awesome, right? So what percentage of your compensation are you willing to tie to results? Right? And if they say 1%, they're not all about results. Okay. And so if you said something like, you're going to hire a marketing firm and we're going to get you 100 leads for $10,000, whatever the number is, right? And you go, how about this? We're going to pay you $5,000 as a base. If you get 100 leads, we're going to pay you that $10,000. If you get 80 leads, we're going to pay you $8,000. If you get 120 leads, we're going to pay you $12,000, right? You're trying to tie compensation to results, okay? And that is one way to build trust, right? Everybody's aligned. Next, tying payment to specific benchmarks, right? Making sure that the way that they are paid, right, ties to the actions and deliverables you want to see. Okay, so for example, if they're building you a product or they're delivering you a consulting project, you have to make sure that your payments hold them accountable for the pieces that you expect and when you expect them. Okay, so we work with a developer. When they get the plan for the whole development approved, they get a certain amount of money, right? And that's really appropriate because, right, you're tying the payment to the specific benchmarks that you have put in place. Okay, what happens if you don't do this? Well, if you pay too early, it's hard to hold them accountable. And if you pay too late, right, they feel like they're not being adequately compensated. Remember, what we're trying to do is we're trying to get to people that thrive in these environments. We want to tie our compensation results. We want to get paid when we do what we say we're going to do, and the rest of the things here. Those are the people that you trust, right? And these are the mechanisms to evaluate, right, how you align with them and how much you can trust and rely on them. Next, just like with staff, no magic here, establish goals and metrics, right? You want to make very clear that if you're supposed to get 100 leads, you're supposed to get 100 leads, right? And that becomes the objective way to measure. And that goes with the next one, which is very different, very similar to staff, which is a regular process, right? Reporting and regular meetings and check-ins to report against those against those metrics. Another thing that helps you build trust is how many times have you hired a vendor and you come to the first reporting meeting and you have to show them what they should be reporting on? What does that tell you? Remember the definition of trust: ownership and performance. Does that tell you ownership? Okay. We recently had somebody that went with a new wealth manager, and that wealth manager had information for 2 months and showed up for the first meeting, right? Now, what would you expect the wealth manager to have in the first meeting? We've analyzed your portfolio. We've come up with X. We had certain situations. And they showed up with a white pad. And I was like, you guys are 5 seconds from losing a $5 million account, because that is not, right? That is not ownership and performance. Okay. And what you should do, and again, remember, this is about building trust. What you should do is don't tell them, right? If you have to tell them what to report to you on, and they're supposed to do this all the time and bring expertise, right? You should give them, and frankly, to be honest with you, when that doesn't happen, you probably should walk out of the meeting going, I picked the wrong people, right? Because the right people should show up and say, this is what we do for every single client. This is how we report. We're going to come every week and do the same thing for you, right? We're going to show exactly where you are, and we're going to get to the part where we actually give you recommendations. We're not going to talk about the reports that you're building and things like that. So how many times have you come to a vendor meeting, right? And you're ready to discuss a strategic issue that you're struggling with, and you spend all your time, getting the reporting right on what happened yesterday. Those are vendors that you should fire, or put differently, those are vendors you should not trust. Okay, remember what you're doing here is you're putting in place mechanisms to determine, is this somebody I'm going to be able to rely upon? Okay, and by having regular and consistent meetings to check in on, and regular and consistent goals and metrics that don't change, right, give you the mechanism to determine if a vendor should be trusted. Okay, and then finally, some type of financial implications or termination tied to those results. So we talked a little bit about compensation, but it may also be, right, if you don't deliver on the ultimate objective, there's teeth, right? And those teeth might be you give money back, right? That those teeth might be the contract is terminated, right? There is an implication to the fact that they're not performing. Okay, so many of you may have come into this webinar going, yeah, how to build trust. Yeah, you kind of get to know them and you see what they're like, and they have a nice family, and they contribute to charities. That's not what trust is in a business environment. It's ownership and performance, right? But by the same token, if you don't set up the mechanisms, right, to determine that and to evaluate that, it becomes very difficult to determine the people that you can really rely upon. Because, as in a growing company, whether it be with staff or vendors, you've got to get to those people that you can trust, right? And if you don't have the ability to rely on certain people, then it becomes very difficult to grow. Okay. And then finally, investors. Okay. One of the things for many people that have never worked with investors or raised money before or gone through it, it's really like we call it at Lonely Entrepreneur, surviving on planet investor. It's literally like going to another planet. There's a different language, there's a different cadence, there's a different perspective on things. And a lot of times in the investment process, they tell you that your baby is ugly, right? Like there's all these things that go with it. And it's really important that you understand how to work with investors and how to build trust in investors. And one of the things that makes this really, really difficult is that a lot of times the underlying motivations of investors are different than yours. And that sounds weird, right? You're like, wait a minute, you're giving money because we're trying to do the same thing. But you have to understand that it's a zero-sum game. What I mean by that is there's a pie, right? And that pie is carved up between how much you as the owner and some other people own and how much the investor owns, right? And the more the investor owns, the better it is for them and the worse it is for you, and vice versa. And in many cases, those underlying motivations drive a lot, right? In probably 1 of 10 cases, investors take the view is that if we just grow the size of that pie, everybody wins. And so I don't look at it that way. But many, many, many of us have experienced that you just have to understand that there are these underlying motivations. That doesn't mean that they can't be really good for your business, but it also means it becomes harder to trust them, right? And if you really develop trust in investors, it's usually because you've done one good deal together, and everybody's won, and you're going to have at it again. Okay. Next is, and this is a little bit off topic, but I wanted to make sure that we covered it, which is understanding the role that money raisers play. A lot of people hire third parties to raise money. Usually it's not for $50,000 or $100,000. Usually it's at least a couple $1 million money raise. And the reason for that is most of the time these money raisers, not all the time, but most of the time these money raisers are paid only on success, right? They're paid, 77% of what they raise plus some warrants. With bigger raises where more work might be done, they might have to pay a little bit of a couple $1,000 retainer a month. But for the most part, they're paid for on success, which is great. And in that sense, it's good. But here's what I want you to understand. When you hire a money raiser, right? Yes, they work for you. You have a contract with them that says you're going to raise $5 million and you're going to get 7% of it if you do, right? A lot of times the reason you're hiring these money raisers is because they have relationships with, VC firms, private equity firms, private investors, right? So let me ask you a question. When they come to you, how many deals have they done with you? 0, right? How many deals have they done with all those investors? Well, if they have established relationships, lots, right? So when you're working with a money raiser and you're frustrated that you're not raising money and you pour your heart out saying, yeah, you know what, I know my valuation is 30 million, but I would take half that. Don't think that's not getting back to the investor. Okay, there is an inherent natural thing to do, which is to trust your money raiser because you've hired them. You're going to pay the money. So you're going to tell them all the, all the gory secrets because, you want them to know that because you want them to help. But you have to understand one of the values that they bring to the table is the fact that they have relationships with all these investors where they've done 43 deals, right? So if I've done 43 deals with somebody and none with you, and by the way, once I do one with you, maybe I do one or two over the course of our whole lifetime, but I'm going to do 43 with them. There's not, again, I don't want to make it sound like money raisers aren't trustworthy and investors aren't trustworthy. There's built-in inherent incentives, right, that are a little bit misaligned to developing a real trusting relationship. So again, make them earn your trust. Okay. I know one time before I learned all this, I just started to hear from some potential investors, like things I had told my money raiser. I was like, how do they know that? There's no way they could know that. And so what did I do? I purposely made something up and told it to my money raiser to see if it would come back from the investor. And it did. And then I fired him. Right. So the point is that in the other relationships like staff and like vendors, you don't have these underlying motivations to a large extent. Aligning success, like a marketing vendor, for example, that success is aligned to your success, not completely aligned, and you have to build those mechanisms, but it's more aligned. But when it comes to investors and to a certain extent money raisers, you just have to be smart enough to understand what these inherent incentives are, so that you can effectively manage it and build trust. Okay. Next is you want to create a standard structure for reporting and the way information flows. Right. So the more regular and consistent you are with investors, right, the more you can have, consistent. You can build trust in the things that everybody says that they're going to do, and that just is consistent reporting, consistent structure. Think about it. No different than you report to clients. If you report to clients consistently all the time and you have the same meetings every month and you're going through the same reports every month, that's a great basis for in my example, for you to perform and to own. And the same thing is true for investors, right? Create that consistent reporting and information flow, and that's a great mechanism for building trust on both sides. Next is never giving without getting, right? And so investors will say, I just want this. I want another board seat. I want more control. I want to put my own person in there. You have to understand that these underlying motivations are not exactly aligned, right? It's like the statement, I'm here from the government and I'm here to help, right? Like you have to realize that there's these inherent incentives, built into the investor company relationship that are often unaligned. So if an investor is asking you to quote unquote give something, and you don't have any obligation to give that, you should get something, right? There should always be a mutual accountability to something. I know in our early days, for many of you know my early venture of, building the first company to reward people for being healthy in the US. we almost didn't build that company. We almost did a deal with American Express to use the American Express rewards platform to do it. And we got very close to forming a joint venture. And I said to them when we formed the joint venture, I said, well, we're forming it and negotiating. I said, just so you know, any rate you guys ask for, I'm going to ask for it. So if you want to go nuts with the rights you want, I'm going to write all the same rights. So let's save the time of saying you get to approve this, because I'm not going to do it unless I approve it, right? So I want you to understand that if when you're going through the investment process, you want to create this balance of mutual accountability that helps build trust. So investors know if I want something, I should give something. If I want something I'm not entitled to, I should give something. Okay. And then finally is creating financial rewards for you and your team. So a lot of times, and this is probably a little bit more than your just basic trust. A lot of times when investors put money into your company, they have what's called preferred equity or preferred stock, meaning that if there is ultimately an exit in the business, they get their money, quote unquote, first, right? And because they get their money first, the people that own the kind of general stock of the company, which might be you and other employees of the company, get their stock after. So let's say, for example, an investor puts $25 million into your company, right? And the company sells for $27 million, right? Well, what would happen? The investor would get all of that, right? And the regular employees, including you, might not get any of it because they come first. Okay, I won't get into the details of why they get all of it, but they get the first whatever. So what you want to do is create other structures. So for example, in my old company, this was happening. We raised preferred equity, and a lot of my employees had options and things like that, but they were down the chain. And so what I did was I created other financial rewards, meaning if the company was sold, each of them in their employment contracts got, X times salary, right? So they weren't just dependent on their equity. Because if I knew investors were going to take the biggest piece of that pie, and they've worked so hard to get this business to the level that they got to, I wanted them to be rewarded, right? And so if I relied just on the equity, and remember, if you bring in more investment, you need to grow the company even more. Then in my example, it might be 25 million plus another 20 million, right? And now your people you got to get to 45 million before they get anything, right? Or 45 million plus the return of the investor. So maybe 60 million before you get anything. But if you create these other structures, right? And, I know the topic of this webinar is trust, but with investors, there's some great investors out there that have made people that bring incredible value to the table and not only provide the capital, but expertise to get people from point A to point B. But there are these inherent, misaligned incentives that aren't natural to build trust. And the best way to build trust is to have what I wrote up there, which is mutual accountability. If you give, you get, right? When you win, I win, right? When you lose, I lose, right? And to make sure that you're aligning all of the incentives, right, to ultimately build trust, right? Because again, what are we talking about? We're talking about ownership and performance. So if I'm an investor and we've negotiated our deal, and our deal is that you get one board seat out of my board, great, and that's part of the deal. You come back later and say, I want a second board seat, right? You should come to the table, give me a second board seat, and I'll give you this, right? And so what is that's ownership and performance and mutual accountability. So a little bit in a difference in the context of an investor, right, than it is versus staff and vendors, because there's different types of relationship. But especially with these money raisers, and there's many great money raisers, but the challenge is that they don't work for you. You sign a contract, you pay them, they do not work for you. They work for the investors that they have done 100 deals with. Okay, and that's sideways, right? That just seems completely off, right? The same thing works. I mean, I'm using it in the context of an investor, but think about people that represent influencers, right? If they're represented an influencer 40 times, right, and they're going to go work with you once, who are they more loyal to, the influencer or to you, right? And so understanding these are super, super important ways that are necessary to build trust. Okay, So, this topic is one that CEOs and leaders really struggle with, simply because probably where we started, which is what is trust actually? Is this conceptual, kind of visceral, emotional thing, or is it something else? There's a chapter in the book that we're really proud on, which is just who should you trust, and it talks all about how trust is earned. Right? You should not trust anybody other than the people that you've worked with before and have done over a period of time, created ownership and have performed. Right? Everybody else should earn it, and when you talk to them and you interview them and you engage with them, you should make that very clear to them, right? That the only criteria for you earning our trust is owning and performing. And anything else short of that, right? That is not the type of company you're going to be able to trust. And ultimately, when you get to the terrific place of people you trust, you have the opportunity to really kind of grow your business, because then you have people you can really rely upon, whether it's management team or staff or vendors or investors, to be able to jumpstart your business. Okay. Thank you as always. I know we have, Steve, we're going to do the poll now, or are we going to take some questions?
I did the poll already. We had a lot of people respond to it. Looks like it's kind of a mix between all three options of building trust with employees, vendors, and investors. Real quick, though, before we jump into the Q&A, we just want to cover, whoops, I think it's in the slide. There we go. Just want to cover the special offers that I talked about in the beginning. So thanks for the presentation on building trust, great content, Michael, as always. And our learning community is a place where you can gain knowledge from more than 2,000 learning modules on basically all the issues that an entrepreneur faces leading his company. We have real-time answers to your questions in the community via chat from team members. We also do unlimited online live weekly group coaching. A lot of those on Fridays are led by Michael. You can also get up to 250 financing resources that are in our community, as well as 150 plus tools, templates, and different agreements that are all pre-built for entrepreneurs. So this is our learning community that I was talking about. You can join for $7.99 for the year. That's our promotional price right now, or $99 per month. If you want to learn more about it and get a virtual demo to see all the features kind of firsthand, you can schedule a virtual demo. I'll drop the link in the chat. It should pop up on the screen in just a moment. The second offer we have is, so our learning community is for a group of entrepreneurs, whereas Sidekick is for one-on-one coaching. Michael's coached more than 600 CEOs, and we've found that a lot of entrepreneurs, they're really great at one revenue generating skill, but a lot of the time they need to grow in the 15 areas of business that really drive success. So what we do is we can provide a customized solution to help you grow in those areas of your business that maybe you're less familiar with, things like marketing and sales, operations, cash flow, legal strategy, and so on. So we provide tailored planning. And really, as an entrepreneur this year, what you're doing now is going to determine your sales 6 months from now for a lot of executives and leaders of businesses. So we want to make it available to you to schedule a free one-on-one discovery call where you can talk about kind of the top things on your mind leading your business right now, and possibly some solutions for that. I'll drop the link in the chat as well, and then we'll get to some of your questions.
Yeah, and I think everybody, to Steve's point, we're trying to help people really at every step of your journey. And so the learning community is really designed to solve the problem of, instead of having to go all over the place for answers and Googling things and talking to your friends and blah, 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 it's I have one place to go to get answers and lots of ways to get those answers, right? And so that's 2,000 learning modules, unlimited coaching, place to get your questions answered by real people, right? Really we think the first one-stop shop that can really save you a lot of time and money. And then the sidekick practice of this one-on-one coaching when you're really ready for that one-on-one help to address, as Steve said, the variety of different issues and really need a quote-unquote sidekick, because we all know that we're all lonely entrepreneurs and really could use a right hand that can bring kind of judgment and value to the table.
Excellent.
Great.
Thank you. All right, so we're going to get to a couple of, we have a bunch of questions in the chat people have been sending, so let's get that started. All right, so Jennifer posted a good comment. The concept of underperforming employees bringing the rest of the team down is also discussed in Quint Stutter's Handwriting Excellence book. That's right, Jennifer. Thank you. There's actually another follow-up question to that. But Georgina asked, how do you recommend being able to demonstrate to the vendor that you're reliable? Trust is a two-way street.
Yeah, so to the first question about underperforming employees, to that comment, 100% right on. As soon as you allow the accountability and the level of performance to be downgraded, everybody sees that, right? And everybody just understands that's the modus operandi of the company going forward, right? It's very, very difficult to hold people accountable when it's not to say that you're not trying to support each other and help each other and achieve a goal together. But when somebody doesn't perform and it's okay, it becomes okay for a lot of people. And you really can create some real cultural problems, around that. There is no doubt that trust is a two-way street, and the same mechanisms that are put in place for vendors should be put in place for you, frankly, right? If you're delivering for a client. So think of it, let's look at it as the reverse. Let's think of it when we are the vendor. Right? When we, the companies that are on here, are the vendor, what should we be doing? We should be owning and performing. So that means, use my example of reporting. When we show up, we're going to show up with organized agendas. We're going to show up with standard reporting. We're going to show up. We're going to show up and do, as we like to say, more than they ask before they ask, right? And that's just an element of ownership. Anybody can respond to a request. Can you get me this? Right? It's the vendor that does more than they ask before they ask, right? That ultimately, wins the day and builds trust. I'll give you an example. In the old days, when salespeople used to sell, they used to teach salespeople to come in and ask questions. I'm going to sit across you and ask what your problems and challenges are and listen to you, and don't talk about my product or whatever. Just listen to you about problems and challenges that you have to try to understand you. Well, in this day and age, at least my expectation, I think the expectation of most people, is that not only do you come to the table already knowing my problems and challenges, but you've done enough work to understand how your solution aligns to that problems and challenges. And if you don't show up with that, you're not even tall enough to get on the ride, right? So this is the kind of thing where more than they ask before they ask is one of the ways that you build trust, and it absolutely is a two-way street.
We have another question from an attendee. How should I go about finding the right investors? And is there anything I could do to build trust quicker?
The investment question is a complicated one, because it really there is both obviously the value of your business, but let's say your business has some unique value proposition. It's the ability to build really good tools to demonstrate that. So what does that mean? It means a really good investor deck. It means really good tight financials. It means a well-trained team that really understands why you have the necessary elements, which are a big market, a unique differentiator, a credible plan, all the fundamental building blocks. And if you don't have those, or you have less of those, it lessens your chances of success. The most important one of those is, what's your unique value to the market? And then the other part is targeting the right investor, right? You really have to understand more. Do they invest in my sector? Do they invest in my stage, right? Are they investing in people that are further along, if I'm looking for $500,000 and they don't make investments of $500,000, like sometimes we don't do the research to date the right people before we get married, right? And so we don't spend enough time on really researching what to. As far as building trust go, what's interesting about investors is if you get the unique part right, people get interested right away, right? I know for me, rewarding people for being healthy was very easy to get people excited about it. And whenever they asked us to follow the rules, right, submit this proposal, follow this procedure, we ignored all of them. We're like, if you like this, you'll like it, and if you don't like it, you don't like it. But when they say, VC says submit all your proposals through the website, and you should do that. But if something is compelling enough, you will get interest right away. Now that's not really trust, right? But what it is I assume what you're looking for is not necessarily trust. You're with investors, if that's what you're speaking about, you're really talking about how do I accelerate the process, right? So I can get them interested more quickly, and then ultimately see if there's a great partnership there.
Another question that came in was, are there any interview questions that you found to help find employees that you could trust?
Yeah, it's a great question. What in this day and age, especially with AI, it's really incredibly easy to fake it in any role that you have, right? You could interview for a job as a nuclear physicist and with a half hour on AI come off really, really, really smart, even though you would know, nuclear physics if it bit you in the butt, right? So Steve, I think one of the best ways to do that is to put them on the spot and have them demonstrate their capabilities there. And so what do I mean by that? So let's take, and Steve, you've been with us for a while as a marketing person, like you went through this. Like we basically said, give us a page, one page, right? And people were like, on what? And we're like, whatever is the reason why we should hire you. Right? And don't give them 5 days to do it. Give them a day, right? Now, why is that, right? What you're trying to do is you're not looking for them to say what they can do. You're looking to show you something. So let's say you really, 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 really wanted the job, right? And you really had the capabilities. What would you do on that one page? You would try to bring strategy, you try to bring execution, you try to bring creativity, you would try to, and frankly, you might even ignore the one page. You might even say, I know you told me one page, but I'm going to give you 5 pages because I'm going to show, like, these are all the things that, and in that one page. So imagine somebody that said, and we've gotten these, I'll use marketing as an example. We've gotten I'm going to get in, I'm going to evaluate your goals, I'm going to build a plan, I'm going to execute a plan, and it has nothing of any substance in there. Never looked at competitors, didn't look at webs. And think of the other end of the spectrum, where you went into the Google search words of competitors, I'm making something up, and did an analysis of where, and so what you're trying to do is not so much with the questions, but the action. So take the role and see if they've ever done the role before, right? Whether it's operations or sales or baking cookies, say, give me a page on what's the best way to bake cookies. And what's going to happen is you're going to see a continuum of really, really good kick-ass to really, really, frankly, lazy, right? The other thing is when you're interviewing, ask them, what can we tell you? What can we tell you about us? What would you like to know about us and our company? Really good people, right? Don't say, how much does the job pay? What time do I have to go home? Do I get to go home? Really good people, especially in more senior roles, the more senior you get, should be super inquisitive about the company. They should want to know, they should almost be a pain in the neck. They should almost be like, I want to know the vision. I want to know the revenue. I want to know the revenue goals. I want to know who the investors are. I want to know, and then some things relative to there. Because what does that show you, right? That shows you that they're thinking about the business, right? They have some kind of visceral caring about the business and would do that in their role. And remember, this is the honeymoon. They're trying to get hired. If they're not showing these characteristics that they have it during the honeymoon, imagine when you're married for 10 years, right? Like Like you have to. So what you have to be able to do is have them show you, right, in a finite period of time, right? Sometimes you can even do it. You give them an hour. Well, why is that? Well, unless you've done the job before. Like if you would ask anybody on our team about the things that they've done before, right? They should be able to score it out a 1 page or an hour because they've been there, done that, right? The ones that haven't done it in an hour, no chance, right? So put them on the spot.
Yeah,
that's great. Marco has a question about, when monitoring, kind of providing a more rewards-based incentive program and monitoring that to kind of drive trust and growth. How do you do that kind of on a smaller scale with maybe it's like maybe one hire you can make or a smaller budget?
Yeah, so I think that one of the mistakes that compensation structures have at times is they rely on just annual bonuses for jobs, right? And so people feel pretty, if you make $100,000 a year and your bonus is $15,000, and it's an all or nothing, and it's tied to, not just your results, but maybe company results. I mean, that's just too far off in asking people to do this. And so we dealt with this a lot in our healthcare rewards business. You're gonna cure your diabetes, and if you cure your diabetes, we'll reward you. Well, I mean, that comes down to going to the gym and eating pizza and like the things you do every day. And so you can't do that. You got to break it down into these much more near-term, smaller rewards. So I think that, like any of these other, trust mechanisms, you're trying to align. So that means that take a portion of compensation, a meaningful portion of compensation, make it incentive-based, and then break it down into workable chunks where you might earn something every month. Right. So if you have a $50,000 salary and you might have a $10,000 bonus, somebody earning, 1/12 of that every month can be meaningful. Right. And so I think, Marco and others, you just have to understand that it's not human nature to say, I'm going to do something for 12 months. It's different if you're like a Wall Street trader, right? Where that you're going to make a salary, but your bonus might be 5 times your salary, right? So in that case, you're like, it's big enough that you're working the whole year to be able to do it. For most roles, though, that's not the case. For most roles, you're trying to say, how do I make the biggest percentage of this incentive based, right? And still get good people. Like there's people who are like, I'm just going to hire commission only salespeople. Well, it's hard to get really good commission only salespeople, but salespeople are largely aligned to results. Can we take that same philosophy and apply it to other roles by clearly defining goals and having these rewards be more incremental than just all or nothing, if you will?
That's great. And another question, Michael, how do you foster trust within, kind of boss and employee, right? Because it's a two-way street. So how do you get your employees to trust you? And then how do you, as a leader, trust your employees to make good decisions in the best interest in the business and make sure it's a two-way street?
Yeah, I think with respect to with staff, I think it's the mechanisms that we just talked about in the webinar, right? You have performance objectives, you have clear goals. We watch you perform, we watch you own, and I definitely think the ownership. I mean, there is a difference between people that really own versus people that do. So I think all of the mechanisms we talked about, but certainly you watch that develop. Now, on the other side of the spectrum, what it comes down to is what can a leader give to a staff member who is earning their trust, right? Or candidly not earning their trust. So I'll start with not earning their trust. There should be implications. You don't make much money, you lose your job, you lose stature. Like when you don't perform over a period of time, right? And you don't earn that trust, that there's implications to that. And, to the first question that we had, that also shows that there's going to be an accountability. When you leave people in place that don't perform over a period of time, that affects everybody, right? When you make it clear to people that they're going to perform, and if they're going to perform, right, the good things will happen. So let's talk about that. What are those good things that can happen? What a leader should be doing is, first of all, acknowledging when people hit that bar and saying, this is what it means to really own, right? This is what it really means to take ownership of a goal. And when they do that, recognize it. Number two, continually defining the difference between being proactive and reactive, right? Part of that ownership is being out in front of it, right? Showing up at a meeting and saying, here's what happened, right? Always frustrates leaders. Showing up in a meeting saying, last week, this is what happened. We looked like we were going to fall short. So here's what I did. I don't know if it's going to work out, but here's what I've tried. Right? So the more you recognize that, and this is where values come in, like your corporate values, like when you implement and execute on your corporate values, you're having these conversations when people do. I've watched you perform, and if ownership is one of those values, this is, hey, everybody, this is the difference between owning and not owning. This is the difference between being proactive and reactive. And that type of praise, right? Now, what do you want to tie to that praise? It's the rewards we talked about, financial rewards, right? Also other opportunities. If you start to earn my trust, right, I'm going to give you other opportunities. I'm going to let you sit in on a meeting that you might not otherwise get to sit in on. Right. I, as a young lawyer, because I happened to do something well, got to sit on a meeting that I'm not allowed to talk about that was big. Right. And the only reason I got to do it is because I kind of, I don't know, who knows what I did, but I went above and beyond, or I did something right, or didn't fuck something up, like whatever it was. Like I was able, I got access to something. Right. So, and then there's even more extensive things like that, they start to mentor you. They start to, right, when you find, I'm talking a lot about the negative parts of trust, but that when you do earn it, it unlocks all these other, potential rewards that go with that. So we have to make sure that we're rewarding and recognizing that trust. And this is also what builds the values of the company. Right? When you talk about what people are doing and not doing to earn your trust, it sets the standard that doesn't waver regardless of whether you're staff, employees, investors, or the like.
Absolutely.
Great. Well, wonderful questions. I think that was all of them. Thanks everyone for joining us. And if you missed it or jumped on like halfway through, you'll get a copy of the recording via email in the next hour or so. And thanks again for joining.
Thank you, everybody.